Imagine this. The entire stock market is flashing red. Big tech names like Microsoft, Amazon, and Meta are all taking hits. Volatility is spiking, fear is rising, and investors are running for safety. Yet in the middle of all that chaos, one stock refuses to stay down: Opendoor Technologies, a company that got crushed after earnings hit with weak guidance and even dropped a share offering that usually scares investors away. And still, somehow, it's fighting back stronger than expected. So the real question is this just a dead cat bounce? Or is there something bigger brewing underneath? Because what's happening right now with Opendoor might surprise a lot of people watching the real estate market closely. This past week, the broader market didn't have a great run, and Opendoor followed suit, dropping nearly 12.7%. But in fairness, it still outperformed many other high-growth and speculative stocks that got completely wrecked. Friday's pre-market trading was wild. Opendoor sold off hard, hitting lows around 4.84 cents before bouncing back. If you managed to catch that dip, give yourself some credit. That was not easy to time. Now, the big picture is that most of the negative catalysts seem to be priced in. The dilution concerns, the share offering, the market has digested it. We're sitting at a sort of neutral zone, which could actually set the stage for a rebound. And that's where things start to get interesting, because several macro catalysts could flip sentiment fast. Toward the end of Friday, there were reports hinting that the government shutdown might finally be coming to an end. And if that's confirmed, maybe even announced late Sunday, that alone could trigger a wave of optimism across the market. When shutdown fears disappear, markets tend to breathe again, and risk-on assets like Opendoor benefit first. But the real story is about the data we haven't seen. Because of the shutdown, the market hasn't received fresh labor data for weeks. That changes this week. On Thursday, we get CPI and jobless claims. On Friday, PPI and retail sales. If this data shows any cooling in inflation or a softening labor market, it could spark talk of rate cuts, and that would be massive for growth stocks. When rate cut optimism returns, names like Opendoor often move fast. Now, here's where things get really interesting. Fannie Mae just announced it's removing minimum credit score requirements. That might sound small, but it's huge. It opens the door for more people to qualify for loans and re-enters a big portion of the population back into the housing market. And who benefits directly from more buying activity? Opendoor. Think about it. If there are more potential buyers, especially first-time home buyers who were previously excluded, the entire housing ecosystem could see a surge in demand. And that's exactly the kind of environment where Opendoor thrives. They've built their business model around making transactions faster, simpler, and more data-driven. Combine that with their growing use of AI-powered marketing, and you have a setup where demand can scale fast. It's surprising how few people are talking about this development because it could quietly reshape parts of the housing market. Yes, there's a risk that easier lending standards might echo 2008, but for now, it's undeniably bullish in the short term. Meanwhile, short interest remains a huge factor here. Roughly 22% of Opendoor's free float, about 158 million shares, are currently being shorted. That's massive. Shorts even increased positions by over 3 million shares just last Friday. And something odd is happening. The cost to borrow shares has turned negative. That means some brokers are literally paying traders to short Opendoor. It's rare, and it hints at possible manipulation or at least very aggressive positioning by institutions. Despite all that pressure, Opendoor still managed to hold its ground relatively well, closing Friday around $6.56. That's sitting just below a key pivot zone around $6.57, a level that traders are watching closely. If it breaks above that early in the week, there's a shot at seeing it push toward $7.50 or even $7.90 if market momentum supports it. On the downside, keep an eye on support levels around $5.76 and $4.44. Those areas have shown strong buying interest before. From a technical point of view, Opendoor is still trading below its major moving averages. The 50-day sits around $7.68, while the 100-day is near $4.85. If sentiment improves, a breakout above that 50-day line could flip momentum quickly. But if things turn sideways, We might see the stock consolidate between those two averages for a while. Something else to keep an eye on. No new analyst ratings have appeared on TipRank since earnings. That's strange given all the movement and news around Opendoor lately. It might just be a reporting lag, or analysts could be waiting for confirmation of macro data before updating their targets. Either way, we could see fresh ratings early this week, and those often drive short-term price moves. The way I see it, this setup is balanced. There's clear risk, but there's also opportunity. On one hand, dilution concerns and high short interest create downward pressure. On the other, improving fundamentals, potential credit expansion, and macro optimism could give bulls a real shot at control. And that's what makes Opendoor fascinating right now. It's not just another beaten-down growth stock. It's a company sitting right at the intersection of housing policy, technology, and investor sentiment. If rate cut expectations return and demand in housing picks up, Opendoor could become one of the more interesting rebound stories in the market. The next few days will be critical. If the shutdown officially ends and labor data softens, we could see the broader market ignite a new wave of FOMO buying. And in that kind of environment, Opendoor might just surprise everyone with how quickly it recovers. But let's be real, this is still a volatile play. If the data comes in too hot or inflation refuses to cool, the market could reverse fast. So make sure you're managing your risk and not chasing green candles blindly. Whatever happens, it's clear that Opendoor's story isn't over. The stock's behavior over the next week could tell us a lot about where growth investors are putting their money and how much appetite is left for risk in this market. Let me know what you think about Opendoor's current setup in the comments below. Are we looking at the start of a real turnaround or just another short-term bounce waiting to fade out? I'd love to hear your take. And remember, this video is for educational and entertainment purposes only. It's not financial advice. Always do your own research before making any investment decisions.